Welcome to the Successfully Retired podcast with Hamilton Brandenburg.
Let's talk about Roths today. What do you think, Rick? You want to talk about Roths?
Love it. Mm-hmm.
Yeah, I think there's a lot of mistakes people make with Roths, misunderstandings. We could certainly not get to all of them in one episode.
Yeah.
As I was thinking about this, I thought, what about the 5-year rules? Like that's its own. There's so many different 5-year rules with Roth. I don't even want to get into those today. But people make a lot of mistakes with Roths. They make a lot of mistakes, or there's just confusion around things like Roth conversions. I think we should tackle. Let's talk about that. What's something you see people do with their Roth IRAs that you're like, man, that's just not quite right. You just got something a little off on that, and it costs you some money in taxes.
I think like everything, you get pieces of information. They sound great, but they may or may not necessarily apply to you, or they do, but in a different way. So I think the first thing is just going all in on a strategy that hasn't been fully vetted for your specific situation. And we can tackle some of those, but I think that really is the main issue, is not having a plan unique to you. And so whether that is doing Roth conversions that then trigger different tax events and all that other stuff because you did too many, whether that's putting your money in your 401k in a Roth and it actually shouldn't be, or vice versa, like all those different things. I think it's just really not having a unique plan specific to you. So let's just check off a couple of those that happen all the time.
Everybody's so into Roth conversions and talking about them, at least on the corners of the internet that I hang out with, which is just a bunch of nerds and other financial advisors and accountants trying to show off how smart they are. But people, like consumers, will see this stuff and not understand the context and go do it themselves. And I see people starting to do Roth conversions. They've got a big pre-tax 401k. And they're 48 years old, making $250,000 a year. So they're in a high tax bracket. Like, hey, I heard Roth conversions are a good idea. I'm going to go take $200,000 and convert it to Roth. And they don't really know what they're doing or know why that's a bad idea. So why do you think that's a bad idea? And when's a better time to be doing Roth conversions if what we're talking about by Roth conversions isn't the backdoor Roth? That's a separate thing. We're talking about you've got a big pre-tax 401k or IRA, and you took a tax deduction to put that money in. So you're paying taxes, you're taking 200,000 or 100,000 or whatever, and you're adding it to your taxable income, converting it to Roth so it's tax-free. Why is that a bad idea to do maybe when you're working in the heat of your career?
Yeah, when I do Roth conversions, or at least when we simulate them to figure out, one, is it viable this year? And two, if so, how much for each one of my clients? We run that test every year.
Yeah.
The idea is I want to convert a taxable dollar to Roth, preferably lower than what it was put in, but at least equal to or lower than what that dollar was put in the 401k. A lot of people say, well, why equal to? That sounds like a push. Well, some of those dollars, you didn't have a choice. Some people don't have a choice between a Roth and a 401k. A lot of those dollars were company match that were pre-tax. And so maybe you would have been happy to put them in at a Roth at a 20% effective rate, but you didn't have a choice, right?
Yeah.
So the other thing is the future value of that Roth. If you're not going to spend all your dollars, because now we test it against, well, what's the taxable amount if that dollar transfers to your kids and all that sort of stuff. But for the purpose of this conversation, I want to be equal to or less than the tax bracket that I put that dollar in.
Yeah.
And when I'm working and then accepting another couple $100,000 of taxable amount, that's not going to happen. It's actually going to be significantly more. So I'm going to put that in at 24%, and then I'm going to convert it at 34. Doesn't make any sense, right? So there's that. And I think the opposite of that, which I see more of, because the people I'm talking to are not on the same internet feeds that we are, they don't do any of it.
Yeah.
And so now
that's your real default, is just do nothing.
I now that the opposite of the example you just gave is, I'm sitting on $1 million of 401k dollars. my income just went from 180,000 down to 40 because I retired.
Yeah.
Right.
Yeah.
And I'm just like, I'm going to do nothing for the next 11 years until the IRS requires me to start taking minimum distributions from this thing, and don't even know that this strategy is available, let alone how to plan for it.
And you can fix so much of this by knowing two numbers. What is your current, what's your current top marginal tax bracket and your average or effective one?
Yeah.
And what do you expect your future top and average tax brackets to be in retirement? If my top tax bracket, because I'm working really hard and make a lot of money, is in the 30s, then, and I know my future one in retirement when my income changes and I'm withdrawing is, 12 to the 22%, then that makes that decision clear. I'm not paying taxes at a higher rate to take it out at a lower rate tax-free. I'll do those conversions later. But if you start off, like to your point, you're retired. Hey, I'm going from a $160,000 a year job to $80,000 a year in retirement income. Yeah. You can do that same math and say, hey, my required distributions, my mandatory distributions in 15, 20 years get pretty big. My bracket goes up. If everything stays how it is, then it makes that decision a lot easier. But if you don't have that understanding, then it's a very cloudy decision. And if you're a financial advisor and you're not reading your client's tax returns or asking for them, reviewing them, then you don't know the answer to that. You are not able to service them.
You're an investment advisor and not a financial advisor. So
yeah.
One more point on the Roth conversions, we'll move to the next one. When I do those tests, some of the other things that get triggered that the DIYer doesn't see until it's too late is Medicare IRMA surcharges.
Yeah.
Which is, for the person that's listening that doesn't know, that when you hit a certain income threshold, your Medicare and your spouse's Medicare, because your joint return, both of your Medicare premiums go up significantly.
Sure.
And so for the people that makes sense for, we try to stay under that next threshold so that they don't pay more in Medicare just to get a Roth conversion. There's also some that I've seen where the client has to make the decision if it's going to be beneficial for them long-term or not, where they might be living on more, but their actual taxable income is very low.
Yeah.
So they're bringing income from cash accounts, from regular investment accounts that we love and we've talked about, where they might spend $60,000 or $70,000 out of that account, but their capital gains were only $12,000 that year.
Yeah.
Right. That's an awesome position to be in. It does two things. It gives you a lot of room to do Roth conversions, but also the first X amount of dollars is going to increase the taxability of your Social Security. So when you do the math, it still might benefit you, but it might be less, right? So you have to look at all that sort of stuff before you just say, hey, I heard, even us, I heard Hamilton talk about how Roth conversions are so great and it's going to avoid the retirement tax bomb when I'm 73. So I'm going to do it myself. There's a lot more that goes into it. Have it assessed and then go from there.
Yeah, exactly. And I don't think these reasons that you mentioned, they're all things you need to know about. They're not reasons that you shouldn't do a Roth conversion.
No.
A lot of times.
But it will change the number. It just changes the number.
If you were going golfing, would you want to know if it was going to rain for 20 minutes while you're on the golf course?
Right.
Yes. Maybe you'd grab an umbrella or bring a rain jacket or whatever. And it doesn't mean you're not going to go golfing. You just, it's good to know what's going to happen so you can prepare for it. A lot of times the number still makes sense, even despite IRMA and all those other things, the Social Security taxability. You might still need to do the Roth conversion. You just don't want to be blindsided because you weren't thinking about that and you stepped on a minefield, right?
Yep.
What else we got for? What other stuff do you see people do with Roths that they miss something or they get something wrong?
I don't know where this came from, but a couple people recently asking me if they could contribute to a Roth. I shouldn't say asked if I could. They thought they couldn't because they were contributing to their Roth 401k. So they're Googling like how much you can put in a Roth, and they feel like they've already hit that threshold because it's going in their 401k and don't understand the separation there. And these are younger people that are trying to do right by themselves.
Yeah.
And without understanding it, they could go years and years and years under saving or creating a bigger tax burden than they need to, just because like the quick Google answer doesn't decipher the difference between those different thresholds and rules.
Or they think because they make too much money to put into a Roth IRA that they can't do a Roth 401k. Like you got to know,
right?
401k rules, IRA rules, totally different.
Yeah.
Another thing you pointed out earlier when you talk about kind of how some of these things are different, like let's talk about this. When you talked about converting traditional IRA assets at the same tax bracket as they would be withdrawn later for Roth.
Yeah.
One of the reasons that people might want to do that has nothing to do with like tax efficiency. It is about flexibility. It's that with a Roth IRA, it's a very good inheritance tool for flexibility. You don't have to take required minimum distributions from a Roth IRA. You do have to take them from a Roth 401k. So like you have to know that there's a difference between how each of these two operates. And
to go to the point of flexibility, excuse me, another thing that I think even advisors get wrong is when you look at the math. I'm only looking at the math. I'm not considering anything else. I think you look at the bracket that I'm in, the bracket that I'll be in, right? Or the effective rate, however you do it. And then they assume that the rate that I'm in retirement ought be level because I'm going to never spend those dollars. Like if I'm in a 12% bracket and not taking any 401k distributions, that's great. But as soon as I actually start to spend that money, that bracket will change.
Yeah.
And I might not want it to be equally distributed 12 times a year for the next 22 years. I might want to take out $250,000 to put on a down payment for the lake house by my adult daughter who moved out of state. Well,
and in my experience,
what's your tax bracket now?
Yeah,
right,
exactly.
What's your tax bracket now? So when you look at the flexibility and the transferability, the Roth is going to dominate all those things for the retiree. And so I'm much more aggressive in my Roth savings for clients and also conversions because it checks these other boxes. When you die, the kids are going to not pay a big bundle of tax, like all these different things that benefits them. So as long as it's not super expensive and irresponsible to do it, I'm going to err on the side of having those Roth dollars for all those different reasons.
Yeah. And I don't care who you are, whether you made $180,000 a year while you're working or $500,000 a year, or you made $70,000 a year. When you retire, you are probably not going to just live on a flat static cash flow for 30 plus years of your retirement. You are going to have some times where you want to pull out if you got a couple million, $2, $3, $4 million, or even 800,000, you're going to want to pull a big lump sum off the top for something at some time, whether that's redo the kitchen because you're hanging out at home. You don't want to go anywhere. Guess what? You want a good looking kitchen.
Helping one of your kids.
Yeah, helping a kid out, doing a big trip. I've got some friends, some clients they're thinking like, hey, we might go to the mountains and buy a sweet compound of cabins that, like, whatever that is, you're going to want to have something that you can touch easy as far as your cash flow to go and do big things with outside of your normal monthly kind of income. So like, do yourself a favor. If you are in your 40s and you are not going to retire for a couple decades, please start building something in your Roth and taxable buckets. Don't just put money in your 401k. There's nothing wrong with your 401k, but your future self will thank you for the flexibility. And that's one of the big advantages of Roth.
Let's close with that person in mind. I'm in my 40s and my 50s, and I'm maxing out my 401k. Maybe I have Roth available to me. Maybe I don't. And I make too much. My wife and I make too much to contribute to a Roth. What do I do?
Oh man, are we doing the backdoor Roth at the end of this episode?
Yes.
Okay.
Yeah,
cool.
And how to mess it up. Because that's what this episode's about, is how to mess it up. So this isn't going to be a tutorial on the backdoor. Quick 30-second how it works, and then let's talk about how to mess it up.
Okay, good. So a backdoor Roth, what you do is you make a traditional IRA contribution. So you put your money in your IRA like a deposit, and you do a non-deductible IRA contribution because you're making 250, 300,000 a year. You make too much to get a deduction for putting it in. Both covered by a 401k. Put it in. It's not deductible, and so since it's not deductible, you're able to convert it, and you're not owing any extra taxes on the conversion because you didn't get a tax write-off for doing it. You convert it to Roth, and now you've essentially got money into a Roth. They call it a backdoor Roth. Sounds kind of weird, but you got money into a Roth without going directly into it by doing this conversion, and you build it up. A way to get that wrong is to have a bunch of other traditional IRAs, because there's something called the pro-rata rule. And it basically says that, when you convert part of an IRA, you every dollar that you're converting is proportionately equal to the amount. And here's where it's going to sound fun. You're going to have, let's say you have $100,000 in total IRAs. You make a $5,000 non-deductible IRA contribution, and that brings it up to $100,000. And you convert that $5,000 amount to Roth. Well, now 95% is taxable because see how it follows that same proportions.
Yeah. So you didn't
all that
do
pre-tax amount you put
Roth
in is not coming out. Yeah, exactly. It's proportional.
Yeah,
so simple thing is just roll your IRAs to the 401k if you're going to do this.
Yeah.
Don't have an IRA.
You didn't do a backdoor Roth, really. You just converted a whole bunch of Roth dollars. So for the listener, what does that mean?
The one listener who we just lost by going deep into that strategy.
No, I don't think that's super deep. I think it's important to know because, listen, we know it because it's what we do. I talk to a lot of very intelligent people, high earners that are obviously not in this industry, or they'd probably do it themselves. They've never heard of a backdoor Roth and sure as hell don't know what the pro-rata rule is and stuff like that. So they're walking around not putting, like, I have money to invest. They're walking around not putting dollars in a Roth.
Yeah.
Because they don't know this exists. And then the one guy that sees it on Google or Reddit, but doesn't know about the pro-rata rule, then goes and messes it up. So don't do Roth conversions DIY without really knowing what you're doing. Don't do backdoors DIY unless really knowing what you're doing. Have it analyzed. You can DIY it after that. Pay somebody to just give you an analysis and walk away from them. That's fine. But have it analyzed because there's a lot more going on. I literally just did one this year where one of the spouses left the job. They have a small 401k that we have to leave. It's better for them to leave that there in this suboptimal account to be able to do backdoors for the next 20 years than it is to roll that over, have it managed by me and like all this other stuff. So you just have to know that things need to be in the proper place, know your numbers, and pack as many dollars in a Roth as you can, but do it responsibly.
I'm really glad you said that. That is a great point. If you're making, over a couple $100,000 a year, you and your spouse kind of combined, just think twice before you roll over your old 401k into an IRA. I'll just leave it at that. There could be some really good tax reasons not to. And just because you met with a financial advisor and he's really nice and he wants to partner with you to keep you on track for the rest of your life, that just make sure that that's actually something you need to do. Because it could really prohibit you from doing a backdoor Roth strategy. Not everybody needs to do that. I've had some clients where it's like, hey, no, we're going to roll over the IRA anyway, because we're not doing that. We're doing our Roth 401k and adding to our brokerage account, and like that's their strategy. That's what they want to do. It makes sense for them. So just look twice before you do a rollover.
Yeah, and I think that's the idea about all this stuff. Have that be the plan.
Yes.
Not the thing you do because you're forced to, right?
Yes.
So I think that's a great place to leave it. Roth. Just do it right.
One more thing before you go, you should know that this podcast reflects the personal opinions and viewpoints of myself, your host, and Brandenburg Financial Services. The information that I'm presenting is not a comprehensive analysis of all the topics we're talking about. It's general in nature, and it's not personalized investment advice, so please do not construe it as a recommendation to purchase or sell any particular security or strategy. The views reflected are subject to change at any time without notice, and no representation is made as to the accuracy, completeness, or relevance of the information presented. Guest appearances on this podcast do not represent an endorsement, a level of expertise, recommendation, or any affiliation with Brandenburg Financial Services. This podcast may contain information that could assist you in the development of subsequent discussions with the appropriate professionals. It should not be construed as investment, tax, insurance, or legal advice. Therefore, please consult your financial, tax, legal, and insurance professionals regarding your specific situation. Any forecasts or forward-looking statements are based on assumptions, may not materialize, and are subject to revision without notice. Past performance is not indicative of future returns. Investment advisory services offered through CS Planning, an SEC-registered investment advisor doing business as Brandenburg Financial Services.